Hi, I'm Eric Johnston. I'm the editor of the Australian Business Review. I have here with me today David Rogers, the markets editor of the Australian Business Review. Thanks for coming in, David.
Thank you, Eric.
What we're seeing now is incredible volatility on global markets. What's underlying this, the sharp moves that we're seeing? What's going on there?
Well, it is quite interesting, Eric, and it follows a long period of basically stimulus from the Fed, particularly pumping up asset prices around the world. And market knows, investors know that story is coming to an end. The Fed is wrapping up its quantitative easing, its money printing, bond buying this month. It's on track to do so. And it'll look to start raising interest rates from near zero levels and normalising interest rates next year. Now, in a situation where there's more pressures on economic growth from offshore and a rising US dollar, that leaves them in a situation where they can't really do more other than try and jawbone the market to calm volatility.
But what about in terms of the share market, how is that playing out? So we're seeing these moves of say 2% falls, we're seeing 1% gains just within a few days. Is this a normal market that we're operating in?
Well, it's very concerning because we are in that October period, the worst month for Australia and one of the worst months for offshore markets traditionally, and we do have that coincidence of the Fed ending its quantitative easing this month. Now, we have had the Australian market particularly pushed up by what they call the global carry trade, the selling of US dollar assets or borrowing more precisely in US dollars at low rates and investing in higher rates around the world. So the Australian dollar's benefited from that, Australian bonds and equities. And now the smart money is trying to take some profit before the rest of the market realises that the game is up. So the Fed tried to calm the nerves on Thursday night by saying that things had run a bit too far on the US dollar. It went up like 8.8% in 3 months. But the reaction only lasted a night, and then we had, as you mentioned, that nasty sell-off last night, 2%, and we've pretty much matched that in the Australian market today.
And what about in terms of what's the outlook for the US Federal Reserve raising interest rates? When are we going to start seeing actual moves, not the jawboning moves?
Yeah, well, Stanley Fischer said last night, a Fed member, that considerable time, which is the rhetoric they've been using, means a couple of months to 12 months. So the middle of that's about 6 months, and the market has first rate hike penciled in, or a part of a rate hike for the middle of next year. The Fed actually has projections from its members a little bit more aggressive than that, rising a bit faster and a bit more quickly. But the Fed acknowledges that the market has to deal with unexpected developments, so it's a bit more doubting. But when interest rates start to rise, that unfortunately is that event is going to be seen as a signal for profit taking on all the assets that have been pushed up around the world to an extent.
All right, we'll bring it back home to Australia in terms of, so we're seeing the US Federal Reserve down the track raise interest rates. At what point is that, or how will that play out on, say, the local share market?
Well, for our share market, a lot of the strength we've seen in our so-called yield stocks, our major banks, Telstra, property trusts, utilities, has been derived from the cheap money around the world, particularly from the Fed. So those have been the pillars of our market in the last 12 months. That's basically the banks, Telstra, a few stalwarts, CSL and so on, Woolworths, have pushed our market up to a multi-year high just a couple of months ago. Now, if that cheap money is going to rise in price even a little bit, it is inevitably going to see a bit of profit taking in those shares. At the same time, people think that rates in the US aren't going to rise rapidly, so there's still few options around the world to generate a decent return. So I think that taking advantage of this kind of volatility in those safe stocks is not a bad idea.
Mm-hmm. And also we've talked about shares, but in terms of the currency, so we'll see the same themes play out in terms of the Australian dollar. If once the US Federal Reserve starts or thinking about lifting rates, we'll see the Australian dollar weaken against the...
Exactly. Well, that's the other side of the story. As the US dollar rises, the A dollar tends to fall, and there's no coincidence that the Aussie dollar has fallen apace with our share market, and in US dollar terms it's quite an ugly move in our market last month, more than 12%. So the offshore selling doesn't seem to be finished, and most of the strategists I speak to are going to be trying to gauge their view more in the coming days. They don't think that's finished, and both the Aussie dollar and the shares could be under a little bit more pressure as those offshore sellers vacate. It doesn't mean that there aren't good opportunities for local investors who have, be it tax advantages and so on, but they need to be wary of risk in growth stocks.
Yeah. Okay. Look, thanks, David. Thanks for coming in. It's a comprehensive wrap around the markets. So look forward to reading your pieces furthermore in the Australian Business Review.
Thanks, Eric.
Thanks.